Ladies and gentlemen, I need you to listen closely because what's about to happen in the next few hours could completely reshape the financial world. You think you understand? You see, most people are asleep at the wheel, trusting a system that's been broken for decades. But gold and silver, they don't lie. They are about to strike. And if you're not prepared, you're going to get blindsided. This isn't fear mongering. This is reality. And it's coming faster than most of you realize. Ladies and gentlemen, what's about to happen in the world of precious metals is not a distant possibility. It's a near certainty. The conditions that have historically led to dramatic surges in gold and silver are stacking up before our eyes. And yet most investors are completely unaware. They are blinded by short-term market narratives, headlines that downplay inflation, and the misleading assurances that the economy is strong. The reality is quite different. The dollar is weakening. Inflation continues to erode purchasing power, and central banks are trapped between raising rates to control inflation and keeping rates low to avoid a debt crisis. In the middle of this chaos, gold and silver are quietly positioning themselves for a major move upward, a move that will catch many by surprise. Let's start with the dollar. Every day that passes, it loses a bit more of its value. When people think the dollar is strong, they're only measuring it against other equally flawed currencies. In reality, the purchasing power of the dollar is being eaten away by the relentless expansion of the money supply. Inflation may fluctuate month to month, but the underlying trend is clear. Paper money is losing its ability to store wealth. And when that happens, people naturally turn to real assets, assets that have intrinsic value and have stood the test of time. That is exactly what gold and silver provide. Unlike fiat currency, they cannot be printed at will. Their supply is finite, their value historically consistent, and they act as a hedge against the erosion of wealth. Silver in particular is in a unique position. Unlike gold, which is mostly a store of wealth, silver is both a monetary and industrial metal. It has practical applications across industries from electronics to solar panels, meaning there is consistent physical demand. In addition to investment demand, this dual role creates a scarcity that becomes acute when investors seek a safe haven. The combination of industrial demand and hedge demand creates a situation where price movements can accelerate rapidly once the market realizes the imbalance. In other words, silver is uniquely primed for a sharp surge far beyond what casual observers might expect. Now, consider the broader market context. Most investors are focused on stocks, bonds, and short-term trading gains. They are trusting the system to work as it always has, expecting central banks to manage crisis with skill. But history shows a different pattern. When confidence in the financial system falters, when people realize that debt levels are unsustainable and that the purchasing power of currency is under attack, the first assets to respond are those that cannot be devalued by monetary policy. Gold and silver are those assets. When the masses finally recognize the risk, the rush to these metals will be intense and sudden. And let's not underestimate the psychology of the market. Fear is a powerful driver, and the warning signs are already flashing. Interest rate uncertainty, rising inflation, geopolitical instability. These are triggers that historically have pushed gold and silver prices higher. Investors who act early will find themselves in a position to benefit significantly. Those who wait for confirmation will only watch as prices spike, regretting that they ignored the signals that were clear all along. Timing in this scenario is everything. The surge isn't a gradual climb. It will come as a wave, sudden and transformative, and the people who are unprepared will be caught off guard. What about the broader implications? When gold and silver surge, it is not just an opportunity for profit. It is a signal that the system is under stress. A spike in precious metals refs a loss of confidence in paper money, a flight to tangible assets, and a warning that financial instability is growing. This is why institutional investors, hedge funds, and even some corporations quietly increase their holdings in gold and silver when they sense that the dollar is weakening. They are preparing for a world in which fiat currency no longer guarantees security, and the everyday investor should be paying attention because these movements affect everyone. We are at a critical juncture. Central banks are constrained. They cannot solve inflation without causing economic contraction. They cannot ignore inflation without eroding the currency. This dilemma creates the perfect storm for gold and silver. Once the market reaches the tipping point, when enough investors and institutions recognize the risk, the surge will not be incremental, it will be explosive. And unlike stocks or bonds, where valuations can be distorted by policy and speculation, gold and silver respond directly to the fundamental truth of money scarcity and value. So what should investors understand right now? The time to act is before the market catches on. The surge is imminent, not next year, not next month, but potentially within hours. When it happens, those who have ignored the signs will be scrambling, while those who have positioned themselves appropriately will see the results of foresight and preparation. Gold and silver are not just investments. They are protection against a financial system that is increasingly fragile, unpredictable, and unsustainable. In short, the stage is set. The signals are clear and the opportunity is here. History is about to repeat itself as it always does when currency is devalued and confidence falters. The surge in gold and silver is not a question of, it is a question of when. And when it hits, it will be swift, dramatic, and transformative. Those who act now will not just survive. They will benefit from a once-in-a-generation financial event. And that is why the next few hours are critical. Because in the world of money, timing is everything and the clock is ticking. Ladies and gentlemen, if you think the US dollar is strong, you are dangerously mistaken. Every day that passes, it loses value. And most people don't even notice. They look at numbers on a screen, at indices that fluctuate up and down and assume stability. But the reality is far harsher. The dollar is being systematically devalued by policies that prioritize short-term appearances over long-term stability. Central banks are trapped in a cycle of printing money, manipulating interest rates, and trying to manage debt that has long since grown unsustainable. And in this environment, the purchasing power of the average American continues to erode quietly. Steadily and relentlessly, inflation is not some temporary phenomenon. As politicians and pundits would have you believe, it is a direct result of decades of fiscal responsibility and monetary expansion. Every time more money is injected into the economy, every time central banks buy assets to prop up markets, the real value of your cash diminishes, your paycheck buys less, your savings lose value. Your retirement accounts may appear larger in nominal terms, but in real terms, they are shrinking. And yet mainstream narratives insist that inflation is under control, that the economy is healthy, that the dollar remains the world's reserve currency. This is propaganda, not reality. Look at the mechanics of the dollar's weakness. The U.S. government has amassed debt on a scale previously unimaginable. Trillions of dollars in obligations, promises to spend more than is collected. No real plan to balance the books. To cover deficits, new money is printed. To service debt, interest payments require yet more borrowing. It is a self-reinforcing spiral, and the dollar is the victim. When a currency is continuously expanded, its purchasing power declines, prices of goods rise, wages lag behind, and everyday people end up footing the bill without even realizing it. And the consequences extend far beyond domestic economics. The U.S. dollar is central to global finance, used in trade, investment, and as the world's reserve currency. When the dollar weakens, it affects everything from import prices to global commodity markets, oil, food, metals. Everything priced in dollars becomes more expensive internationally, and the pressure comes home to American consumers in the form of higher prices. This is not theoretical, it is happening now. Every day you see the consequences in grocery store, gas stations, and utility bills. But here is the critical point. The market is not blind to this. Investors recognize the erosion of value and start looking for alternatives. They seek assets that cannot be devalued by central bank policy. And what are those assets? Real tangible assets, gold, silver, and other commodities that hold intrinsic value. These are not dependent on trust in government or central bank promises. They respond to the fundamental truth that money, when artificially expanded, loses its ability to store wealth. Most people, however, are completely unprepared. They trust their savings, their foreign ones, their bank accounts, and assume that the system will work for them. They ignore the signs, rising prices, falling purchasing power, and a dollar that buys less than it did a year ago. They are betting that central banks can solve problems they created, that deficits and inflation can be managed without consequences. But history tells a different story. When currencies weaken and inflation accelerates, those holding cash or debt-based assets suffer the most. Let's examine why inflation is so pernicious. It is not just that prices rise. Inflation hides in plain sight. Wage growth lags, so workers feel squeezed. Fixed income investments fail to keep up. Retirement savings, pensions, and even government benefits fail to maintain purchasing power. The result is a wealth transfer from savers to debtors, from the middle class to those who can borrow freely in a system that prints money at will. The dollar's weakness is not neutral, it is corrosive, and central banks know it. They are aware that inflation is eroding trust in the currency, yet they are trapped. Raise interest rates too aggressively and the economy could collapse under the weight of debt. Keep rates low and inflation accelerates further. This is not policy mismanagement, it is structural inevitability. The very system that underpins the dollar is inherently unstable. Every measure taken to stabilize it is temporary, and each temporary measure further sows the seeds of weakness. The warning signs are everywhere, commodities are rising, precious metals are strengthening, debt levels are alarming, yet most investors are focused on the short-term stock market, convinced that paper gains can protect them from the very forces eroding their wealth. They are ignoring the fundamentals. The dollar's weakness and the pressure of inflation are not distant threats. They are present realities. The question is not whether the currency will lose value, but how fast it will happen and who will be ready when it accelerates. In conclusion, the dollar is on shaky ground and inflation is the silent predator eating away at wealth and purchasing power. This is not about speculation. is about recognizing an inevitable outcome of decades of fiscal and monetary policy. Those who understand the dynamics of currency, debt, and inflation can protect themselves and even benefit by moving into assets that preserve value. Those who ignore it will find themselves blindsided. Their savings devalued, their wealth diminished. The window to act is now before the erosion becomes too severe, before the dollar's weakness triggers a broader financial upheaval, and before inflation pressure accelerates beyond control. Understanding this is not just insight. It is survival in a world where money is being devalued every day. Ladies and gentlemen, the reality of the financial system today is that it is far more fragile than most people realize. On the surface, everything looks normal. Markets fluctuate, headlines report growth, and the stock indices reach new highs. But beneath this veneer of stability, the system is riddled with structural weaknesses, hidden risks, and a dangerous overreliance on faith in fiat currency. The average investor has no idea what they are walking into. Do they trust in numbers on a screen, in government assurances, in Wall Street analysts? And yet these very structures are what make the system vulnerable to collapse. The first problem is leverage. The entire financial world is built on debt. Banks lend money they don't actually have. Corporations borrow trillions to finance expansion or stock buybacks. Governments run deficits that can only be funded through the creation of new money or borrowing from abroad. Every step in this chain of debt amplifies risk. When a crisis hits, even a minor disruption can cascade into a systemic failure. Yet most investors ignore these dynamics, focusing instead on superficial indicators like quarterly earnings or stock valuations. They are blind to the foundations of the system, and that blindness is precisely what makes them vulnerable. Consider the bond market. Interest rates are at historically low levels, not because the economy is strong, but because governments are addicted to borrowing and central banks are intervening to keep the system afloat. The minute rates rise meaningfully, the cost of debt servicing skyrockets, putting enormous pressure on governments, corporations, and households alike. Yet most investors are unaware of how intertwined these markets are. They think the stock market can keep climbing forever, oblivious to the fact that it rests as on an unstable foundation of cheap credit and artificially supported valuations. And then there is the overconfidence of the mainstream. For decades, investors have been trained to trust in the wisdom of central banks and government policies. They have been reassured that the system can always be managed, that crisis can be prevented, and that inflation is controllable. But history shows a different pattern. Confidence is fragile, and when it falters, it spreads rapidly. Bank runs, market crashes, and currency devaluations are not anomalies. They are inevitable outcomes when trust in the system iridesces. The problem is that most investors assume trust will always hold, and that assumption is dangerous. The ignorance of the public is compounded by misinformation. Media outlets downplay systemic risk, highlighting short-term gains while ignoring the underlying instability. Analysts offer comfort by pointing to rising asset prices or employment figures without considering that these numbers are often manipulated or temporarily propped up by government intervention. People believe the system is safe because it has been stable for a few years. But stability in this context is misleading. It is the calm before the storm, not a sign of strength. Another critical aspect is the concentration of risk. Major financial institutions are so interconnected that a failure in one can trigger failures in many others. Derivatives, complex financial products, and opaque lending practices create webs of exposure that are invisible to most investors. When one part of the system falters, it can rapidly cascade through the rest, amplifying losses and spreading panic. Yet very few understand this interconnectedness, and even fewer prepare for it. This is why financial crises often appear sudden. They are the result of long-building risks that investors ignored or underestimated. And let's not forget the illusion of diversification. Investors are told to spread their money across stocks, bonds, and other assets to reduce risk. But in a system where all markets are tied together by debt, central bank policy, and confidence in fiat currency, this diversification offers only a false sense of security. When the dollar weakens, when interest rates spike, or when confidence collapses, nearly every asset class suffers simultaneously. Investors who believe they are protected by spreading risk are often the ones who are most exposed when the system falters. At the heart of this problem is human behavior. People underestimate risk, overestimate stability, and assume that the future will resemble the past. They are conditioned to follow trends rather than analyze fundamentals. They ignore warning signs and dismiss contrarian perspectives as alarmist. But systemic risk does not disappear because it is ignored. It grows. And when it finally manifests, those who are blind to it are the ones who suffer the most. This is why awareness and preparation are essential. Understanding the fragility of the financial system, recognizing the true level of debt and leverage, and being conscious of the illusions perpetuated by media and policymakers are the first steps toward protecting wealth. Precious metals, tangible assets, and strategies insulated from systemic failure are not just investments. They are lifelines in a system teetering on the edge. The market may appear calm, but that calm is deceptive. Beneath it lies instability, ignorance, and risk that is building daily, unseen by most, underestimated by all. So the question for every investor is simple. Will you continue to trust in a system built on illusion, or will you take steps to prepare for the inevitable shocks that are coming? Ignorance is costly. Blind faith in the financial system is costly, and failing to act until it is too late will be devastating. The risks are systemic, the warning signs are visible, and the time to understand them is now. Those who educate themselves, who recognize the fragility and the looming dangers, will not just survive. They will navigate this storm with foresight, clarity, and protection. Those who ignore it will be caught completely off guard, exposed to losses that could have been avoided with knowledge and preparation. The financial system is not as stable as it appears. The risks are real, the ignorance widespread, and the consequences severe. Recognizing systemic risk is not pessimism, it is clarity. Preparing for the inevitable is not panic, it is prudence. And those who fail to see the truth will discover too late that when the house of cards falls, there is no safety in blind trust or wishful thinking. Ladies and gentlemen, the most important lesson anyone can learn in today's financial environment is that time is not on your side. Wealth does not preserve itself. And the longer you wait to act, the more vulnerable you become. Every day the dollar loses purchasing power. Every day inflation erodes savings. Every day, central banks and governments make decisions that weaken the financial system. And yet most people behave as if their wealth is invincible. They trust banks, they trust brokers, they trust markets that are propped up by temporary measures, and they assume that their money will survive the next crisis unscathed. That assumption is dangerous, it is naive, and it is exactly what the system wants you to believe. The truth is that wealth preservation is not a passive exercise. It is an urgent, active, and deliberate process. It requires understanding the forces at work in the economy, recognizing the fragility of paper money, and taking steps to protect assets from both inflation and systemic collapse. You cannot simply rely on the illusion of stability. You cannot trust in government guarantees or hope that the next stimulus or policy adjustment will save your purchasing power. Those who wait for safety nets to appear are the ones who will suffer the most when the inevitable shock arrives. Consider the mechanics of wealth erosion. Inflation steadily diminishes the value of cash. Low interest rates punish savers, offering returns that cannot keep up with rising costs. Debt levels are unsustainable, and governments are trapped in cycles of borrowing, printing, and manipulation that only accelerate the problem. The stock market, while appearing robust, is fragile, supported by artificial liquidity and investor optimism rather than fundamental strength. When confidence falters, paper wealth can vanish almost overnight. Those who fail to understand this risk are placing their future in the hands of a system that is structurally fragile. This is why tangible assets are essential for wealth preservation. Gold, silver, and other real assets are not dependent on faith in government or the solvency of institutions. They have intrinsic value, and history proves that they protect purchasing power when paper currencies fail. Real estate carefully chosen can also serve as a hedge against inflation and provide income that adjusts with rising costs. But the key is timing. Waiting until the crisis is obvious will be too late. By the time the mainstream acknowledges the risks, price of protective assets will have already surged and opportunities will be limited. The early mover gains not just security but advantage. Moreover, wealth preservation requires understanding the psychology of risk and market behavior. Most investors are reactive. They wait until the problem is undeniable before acting, but by then the best opportunities have passed. The financial system moves in cycles and crisis, do not announce themselves in advance. They build quietly, often invisible to those who are distracted by short-term gains. Recognizing these patterns and acting proactively separates those who preserve wealth from those who lose it. This is not speculation. It is foresight grounded in economic reality. Another crucial factor is diversification across uncorrelated assets. Traditional diversification, spreading money across stocks, bonds, and cash, is no longer sufficient in a system where all markets are increasingly tied together by debt and central bank intervention. A real wealth preservation strategy requires assets that are insulated from systemic risk, that respond independently to crisis, and that retain value when confidence in paper money collapses. Precious metals, certain commodities, and international holdings can serve this role. The key is not just owning these assets, but owning enough to make a meaningful difference in your financial security. The urgency cannot be overstated. Every day that passes without action is a day your wealth is exposed. Inflation compounds, debt grows, markets are manipulated, governments make promises they cannot keep. And when the tipping point comes, when confidence collapses, when the dollar weakens sharply, when market participants realize that paper assets are overvalued, those who have not taken steps to protect themselves will face losses that are irreversible. In contrast, those who act early, who understand the risks, and who move decisively into tangible, secure assets will not only preserve wealth, they will thrive amid the chaos that destroys others. It is also about mindset. Wealth preservation is not just about numbers or investment vehicles. It is about discipline, foresight, and recognizing uncomfortable truths. Most people prefer comfort over clarity. They ignore warning signs, downplay risk, and convince themselves that disaster will never happen to them. But the system does not care about comfort, optimism, or denial. It operates according to its own rules, and those rules are increasingly unforgiving. Wealth preservation demands confronting reality, accepting responsibility for your own financial security, and acting decisively while others are still complacent. Finally, remember that opportunity and risk are two sides of the same coin. The same forces that threaten paper wealth, the weakening dollar, rising inflation, unstable markets, also create the chance to gain an advantage. Those who prepare, who position themselves correctly, and who act before the masses panic and secure wealth that others lose. Waiting for confirmation is not strategy. It is surrender. The clock is ticking. The system is fragile, and action today determines your security tomorrow. The lesson is clear. Do not wait. Do not assume the system will protect you. Do not rely on hope or optimism. Wealth preservation is urgent, and it demands knowledge, foresight, and decisive action. Protect tangible assets. Understand systemic risk, diversify effectively, and act before the surge hits. Those who do will survive. Those who hesitate will suffer. And in a world where financial stability is an illusion, foresight is not just prudent, it is essential for survival. So here's what I want you to remember. Gold and silver are not speculative bets. They are survival tools in a financial world gone mad. What's about to hit in the next few hours is not just a price movement. It's a warning, a wake-up call, a chance to preserve your wealth and protect your future. Don't sit back and watch the storm destroy your purchasing power. Act, understand, prepare. And when the surge comes, you won't just survive, you'll be positioned to thrive. Because in the world of money, foresight is everything. And right now, foresight is priceless.